And I think it's important for people to know that when we say it's like 10 to 15 stocks, hopefully those stocks are going up in value and we like them even when they go up. But we, in some cases like this, say, okay, maybe it's an opportunity now to go in on this other company, because you don't want, I think it's important for people to understand, especially in light of NVIDIA, bringing it back home, right, to tech and big tech and NVIDIA. People don't always realize, by the way, if you're in the S&P 500, you're in NVIDIA. And so the S&P isn't going up as much as NVIDIA, but you do have some exposure there. So understanding diversification, I think, is really relevant. Walk us through that in terms of your own philosophy as a fund manager for the last 20 some odd years and how we implement it at 76.
Yeah, I think what's interesting, when we look at the last 30 days in particular markets, and this is a theme that's recurred, over the decades, where, you have these rallies in technology and, growth stocks, and they really kind of drive returns. And it becomes to some extent self-fulfilling where, portfolio managers sort of say, wow, I don't own NVIDIA and that's killing my performance. I need to go buy it. And so it kind of sends those stocks up even higher. We've had a very, very significant divergence between growth and other parts of the market, or just between like the big market cap leaders in the market versus smaller cap names. So I would my suggestion is that investors should, remember that there's more to the stock market than NVIDIA. There's more to the stock market than AI, even as important as a theme it is. And there's a lot of opportunities there are a lot of opportunities elsewhere. And, that's also, part of what we're doing within the model portfolios is finding, good balanced opportunities where the fundamentals and the growth outlook are durable and strong, but the valuation is not getting overextended as it potentially is with some of these large cap tech names. And where you're just not as complete, your portfolio won't be as completely reliant on a handful of high multiple, high growth stocks and sort of broader market sentiment. So,
yeah.
Yeah.
I mean, no, but it's so important to think of that. I mean, diversification being critical. I mean, look, you can go and buy the S&P, and the S&P is the S&P. I mean, I think what we're trying to do is something more direct and articulated, right? Because if you're in the inflation protection portfolio, the idea there is that you're basically, and this is going to lead me to the US dollar, but there's fear and concern that the US dollar over time is going to be increasingly challenged because of inflation, right? I mean, you have only to look at the inflation we're dealing with right now, which is rather significant and nowhere near the inflation that you would need in terms of wages to keep up with things, right? So think about it. If you're going to retire 5 years from now and you're like, okay, I just want to make sure that whatever I think I have to retire on is worth that, hopefully some because of the growth generated from the equity portfolio, but also you need to make sure that those companies are keeping pace with inflation. It's not just about growth, it's getting growth on top of the inflationary measures, which people don't always think about.
Yep. I don't think a lot of people in the investment business will go and say you should go buy the S&P 500, or other than Warren Buffett, that you should go buy the S&P 500 or that you should go buy the NASDAQ triple Qs. The active management industry doesn't really make money by giving that advice. Right. But I do think that is sound advice. If you're going to be invested in the market, having a large amount of passive exposure to the S&P, to the NASDAQ, that's like a great starting point and a great sort of foundation. And that should be a large allocation for your equity portfolio. What we're doing though with the model portfolios is offering, more specific ideas that aren't just replicating the exposure you're already going to have, if you buy the S&P or if you buy the NASDAQ. Looking at more idiosyncratic opportunities that might be underrepresented with those passive approaches.